All right, Krishna Kumar joins us now. Let's take our conversation forward to understand that how exactly are foreign institutional investors looking at India post-budget? Are they excited? Are they charged up? Or are they maintaining a balance between emotions and pricing? All right, KK, I can see it's a different look. It's a haircut. I mean, nobody's talking about a haircut in this market. You've taken a haircut?
No, it's not. It's the same old guy, the same old looks, just getting a little older.
All right. How excited are you about the re-rating of India story post the budget? The FI activity seems to be indicating that for a market which for the longest time has competed with China and Brazil, India clearly is on a pedestal positioning.
Yeah, I think it's interesting that we kind of turned quite positive about 6 months back, and our stance has been quite overweight India. Variety of things. I think one that things normalized much faster for India compared to the rest of the world, and India got back. The second is the rate environment has been benign. Currency has been stable, so which kind of gets a lot of money into India. And the good part of the story is that the government finally kind of thought that fiscal prudence can be put aside for a while and maybe get the reflation trade back. And government spending is very key and critical. So that makes, in summary, India is a good investment destination, and we've been far more positive than we have been ever in the past. Not ever in the past, but sometime in the past.
How would you perhaps talk about the risk-reward ratio for a market like India? One side is the promise and perhaps visibility of where the economy is moving and how earnings have recovered. But on the other side, you've got a market which is up 100% from the recent low. It is up more than 10% from the budget days low, and it is the best outperforming market, at least in the region. Is it time to get worried about the levels and about valuations, or this market has a long way to go?
So let me put this in context. But to me, with the risk of sounding very old, but it reminds me of 2004 to the extent that when the bank rates were pretty low and the earnings recovery was coming through, and it can sustain for a fairly long time. And when I say that, I'm looking at a typical environment that we are sitting today. Maybe at a point in time, the valuation will look high or low. But in my mind, or the way we think about it is, over the next 3 years, you could see earnings CAGR of about 25%, which is quite spectacular that at a point in time, it might look expensive. There are 3 reasons to, if I may summarize, why we think that this has got legs, and maybe at a point in time, it can look expensive otherwise. I think that the rates are low and very attractive. Corporates are clearly benefiting out of the entire rate cycle, and this could possibly lead to the next level of capex. And when I say that the private sector capex can come through because of the benign rate environment, I feel also the banks are now ready to support the capex if it comes through, because the banks have washed their sins and capitalized themselves, and they're ready for the party to kind of go out and disperse more money and put some risk on the table. And the third thing is that the currency has been very stable, that it kind of gets foreign currency in and supports the entire cycle. What is most important is, in my mind, is the operating leverage. The system is currently at about 72% across manufacturing, across sectors. And if the operating leverage kicks in with some additional incentive or impetus for demand, the operating leverage, when it plays out, goes from 70 to 80. And Indians we are very sticky with costs, and we are very fussy about profligacy. So we tend to kind of be quiet. And if the operating leverage comes in, you will see that the cash flows and the profitability will rise quite dramatically and disproportionately. So this could be a comeback year for the markets in terms of earnings, but you can see this follow through and it propels itself as more of a self-fulfilling prophecy over the next 2-3 years. It's a long answer, but I could see that earnings could sustain over the next 2-3 years and could see a CAGR of about 25%.
Krishna, the template which you've spoken about is a template is a commonly discussed template. A lot of money managers now are bracing their portfolios to benefit from cyclical recovery in the earnings. My only fear is that don't you think this trade is getting crowded and markets are pricing in, which is that the template which you have indicated may actually well play out, which is that operating leverage kicks in, earnings recovery also starts. But that's like a common trade now.
Yeah, things will get consumed. People will believe that everything is priced in and more. That's the classic bull market. We just possibly kind of worry that this may end and this may not sustain. It's good to be paranoid. It's good to be careful. But what I believe is our valuations discounting a 3-year CAGR of 25%? Probably not. What we think is this can propel, numbers that can surprise over the next 12-24 months, given ceteris paribus. I mean, other things remain constant. Though there are issues which are lurking in the corner, which can possibly derail the entire thing. It could be like, inflation expectation in US has been rising. Agri-commodity inflation has been rising in India. Inflation is the joker in the pack, in the room, right? I mean, it could possibly kind of surface. But I agree, it's a more templated and it's possibly now maybe discounting at this point in time. But the follow through will possibly be a bit of a surprise element.
Okay, fair enough. So India, of course, continuing there to be in a prime spot, and earnings also starting to look up at this point. Krishna, when everything has kind of been, seeing a little bit of froth, and we've been seeing buying coming in across the board, a lot of positive assumptions about the way ahead. Is there anything in the market that's still looking a little risky to you at this point? Because now we're also starting to see participation across segments, across different tiers, mid cap, small cap. So we are seeing participation and, of course, continued highs on those flows.
Yeah, I mean, flows can cause a fair bit of bubble or excesses which may come through, but you must, worry about, we stay paranoid about everything, but we kind of also keep an eye on the IPO market, which kind of leads. See, the bankers are the classic guys who, I don't know who they work for, but the point is they, I think most of the time work for themselves. When they kind of price assets and create that little artificial demand in the system, and people are falling over each other to make money tomorrow morning, those bubbles and bursts and hurts and injuries can disrupt in terms of the market. But having said that, the institutional investor has been careful, but it's the retail when it gets hurt, it kind of causes a bit of disruption. But as Nikunj was talking about, I think he's as old as the market, so he will probably kind of reflect these things better. As bull markets typically will see sharp, deep, and savage corrections, which can happen when valuations kind of run ahead of themselves.
Absolutely. All right. When it comes to technology as well, that's one segment of the market. Talking about run-ups, that's really seen a phenomenal move coming in. On the back of that, and I'm just going to also club in telecom and IT in the same kind of mix at this point of time. But on the back of that, what's the kind of opportunity that you now see going forward for some of the heavyweights in that space? I know that you've got some holdings as well when it comes to some of the key players there. What's the outlook on that front?
So we were a bit early in the trade, and we were sitting on both IT and pharma when they were getting. Luckily for us, we were able to buy a lot. But at this point, I think IT and pharma both are getting close to done. And when I say close to done, I do not see IT and pharma having earnings compounding the way market perceives or possibly imagines. So we do a interesting measure which is called market implied growth rates. And market implied growth rates for both IT and pharma in their multiples are clearly pricing in a lot more than what reality would possibly be. And so we're very cautious and possibly over the last quarter or so, we've been taking money off the table in both IT and pharma specifically. And we've been more focused on the inward-looking, local, domestic place.
Just an extension of that point as well, Krishna, because, one wonders now with 15,200 levels and the beautiful rally, one way pretty much, that has transpired from the March lows, whether or not you need to now tactically realign your portfolios, and not just across sectors, but even in terms of market caps. Do you need to ease off from the large caps, deploy or allocate higher to mid and small caps right now? Would you say be market cap agnostic? It's about individual stocks and stories.
Yeah, it's kind of a bit cliche that India is a stock market where stock pickers make money, and that's fine. I think we are reasonably agnostic about market cap, but what we are very fussed about is cash flows and operating leverage, and also moats in businesses, which kind of help. You can make a tactical call saying that, TCS run up or Infosys run up, whatever be the name as you may want to. But I would think that if the call has to be made, one is to think about what we are doing is we continue to remain overweight India. We continue to remain overweight the frontline names, and also a sprinkle of mid and small cap, which helps us to get that little beta up. And they can be quite fierce when they kind of turn around. But tactically, you could take money off the large cap, but the fact is the transaction cost for us is very high for us to jump in and jump out. And we're kind of not very flustered at this point in time, though we're kind of we're very aware that the valuations appear to be quite full.
Sure. When you earlier said that you're looking more inward and looking at more domestic stories, where within the India theme do you find most preferred bets? Because, while there is one part of the traditional India, you've got your old economy names, you've got a couple of auto companies, largely rural dominated as well. And then on the other hand, you've got the new age India, which is not just restricted to the large cap IT big boys, but again, you've got platform companies, you've got digital aggregators, all of which now coming to the markets, and a strong listing pipeline as well there, if I may say so. And, you've got exchanges as well coming up. So, digital is now becoming a very large pool, and it's not just restricted to services.
Yeah, I mean, I see the pipeline of the new age digital companies. In my mind, the valuation or expectations are close to outrageous. And you can keep talking about examples, population and everything else. It is discounting all that and more. And I don't know how they kind of think about valuation for those companies. You can do a contrast with the Chinese digital companies, which have done extremely well, the Pinduoduo, the World, the Kuaishou, Meituan. There are tons of them, but they were initially what appeared to be, outrageous, eventually kind of kept doing well. But what has happened is over 2-3 years, they've consistently delivered and delivered really well. I'm not sure whether the companies that are coming up in India are all in that same bucket of competence of the Chinese equivalent. So I think it's good to be a little careful about the pipeline of initial offers. And digital world is interesting. A lot of things happening there, disruptors and fintech and platforms. Everything is like amazing, and India is clearly making a mark. But I suspect you have to keep an eye on the space and look out for valuation rather than just buy because your neighbor is buying.
Start T. One of those companies where markets sometimes view it as NBFC, sometimes as a real estate builder, sometimes as a pharma company. It's one of those patches in the market where underperforming stocks are actually making a comeback. State Bank of India, from the budget low, is up about 100 rupees plus. I think it was 270, 280, which now stands at, where is SBI? 390, 395. Okay. KK, would you be tempted to look at PSUs, which traditionally global investors have avoided? They've always preferred a private bank ahead of a PSU bank. They've always preferred a private company ahead of a PSU company. But given that government is this time serious and they are saying that, look, we will only retain ownership in strategic sectors and we have no business to be in other businesses.
You see, the government has always been serious about PSUs to only take money out of them. The fact that investors or minority shareholders have always got shortchanged. I've had made several representations to the government saying that minority shareholders are important because you come to them for money as well, or you kind of need them for a variety of your interests. I'm not convinced that the government thinks that minority shareholders are important element to any decision making for a PSU. Having said that, I can see some of these oil refiners are very cheap, very efficient, and are possibly kind of beginning to see the privatization staring at them. That can change the entire landscape. Believe me, I mean, it is a situation where they are now being pushed to get them to believe that there is a real world out there, and they will possibly have to follow that path and not kind of keep supporting them. To answer the question whether PSUs are in our radar, answer is yes, and answer is where the government holding is down to a threshold level where it can possibly only privatize from there or becomes not a majority shareholder. We'll evaluate PSUs where the government interference is lower and they do not think that minority shareholders are absolutely irrelevant in the overall shareholder book.
How would you view a company? I'm using, let's say, Asian Paints or Pidilite as examples here. These are companies which are great companies, great return ratios, very expensive, but they continue to grow. Asian Paints, excellent volume growth. Pidilite, excellent expansion in margins. Marico, strong numbers. What I'm trying to perhaps understand from you, KK, is that very easy to dismiss for people that these are expensive stocks, but when you see this kind of in growth, it is absolutely amazing. So how would you balance it now?
No, it is very difficult. I mean, for me to fathom Asian Paints and put a valuation to it and think that it is rightly or wrongly priced, to me, it is a fantastic company. Let's not take anything away from it. It's kind of delivered. It's consistent. Its corporate governance is the highest order. All said, it's all priced in. So we possibly, do not tread that path of buying what everybody likes. So we are in the contra world where where money is to be made maybe a little more than the rest is when you take a view of buying into names where it's less crowded, it's kind of, there is a little bit of disbelief, there is a inherent mispricing of the asset. And, there has to be a kind of upside, which is not imminently discounted in the pricing. So we will think about those names where we kind of see both margin of safety and also a mispriced asset, and where we think that there is a bigger opportunity to make. I mean, Asian Paints can give you market plus returns for sure going forward. I wouldn't know, but your margin of safety and the mispricing of asset is possibly non-existent in these kind of names.
KK, we come back to the whole original thesis of this bull market. Low interest rates, lot of liquidity. Do you think till the time global central bankers will not move and the real rate in US will remain negative, this bull market will be alive and kicking?
Is that your theory?
No, I'm asking you because that's a theory which a lot of people are discussing and debating, that don't look at inflation print, don't look at valuations. The big picture is that real rates in America are negative, central bankers will print money, and this bull market will remain alive because central bankers prick a bull market. It is central bankers essentially have to move for the bull market to get pricked.
Yeah, so that typically comes in. I agree with you that if that's the thesis, it is a bit dangerous because it is to be seen in light of the fact that asset bubbles are formed with massive liquidity, right? Asset bubbles are not very visible as of now. Is there asset bubble in the marketplace in US? I am not very convinced. There are bubbles in pockets, but these are not bubbles which are large enough for you to kind of go out and say that the central bank will reverse rates. But what I think in my mind is liquidity can create bubbles, and that is a fact of life, and we all know that. What is important is what pricks the bubbles are the inflation expectation when monetary tightness comes in and reversal starts. And, I think inflation expectation is crawling up, which people are ignoring. I mean, US inflation expectation has gone to past 2 now. Second is oil has gone to 60, 61. All said and done, digital world, solar energy, everything is said and done. India still kind of has a little hiccup and choke when oil goes past 60, 65, 70 maybe. So the global trends are, possibly ignoring some yellow lights, but liquidity rally is not resulted in bubbles of that magnitude that one will be very worried as of now. There could be pockets like the US digital space is in a bit of a frothy place, but I'm not very convinced that the entire marketplace is a complete bubble.
Just to touch upon the consumer pocket as well, KK, is that an area where you see opportunity, limited holdings there for now? I mean, both on the discretionary front as well. I mean, how are you viewing the play on the back of the so-called recovery? Because right now all the focus is on cyclicals, on infra, on financials. When do we see it actually kick in with regards to, the consumer story as well?
So the consumer space has been quite expensive. The staple side. But having said that, we are very positive consumer discretionary, and we kind of believe that the household savings have risen quite sharply over the last 3 to 6 months, and the savings will get converted to discretionary spends, which will possibly kind of show up soon. The staples piece, I remain a bit concerned, though there will be enough demand coming from the household as well. But what is important is to see that the agri-commodity inflation has been pretty strong. Oil prices have kind of translated to LDP, HDP, packaging material prices to rise. Second is, if you think about bran oil, or if you think about even copra, the prices are up quite sharply, and the companies are struggling a bit to pass on price increases, and they're focused about volume growth. At some stage, this will hurt. So having said that, consumer staples has been a space where we've kind of been very, very picky and choosy. But we are more focused on the consumer discretionary space, where I think there is a fair bit of opportunity.
Okay, so we do see opportunity coming in on the consumer discretionary front. Krishna, thanks so much for joining us. Always a great pleasure talking to you in detail about some of the things unfolding when it comes to the equity markets.